People are always worried about the wrong thing with the IRS.
CPAs and financial planners don't communicate very well.
There's nothing that's going to replace the combined knowledge that we have in putting it together.
I always feel that tax laws are always in pencil and not in pen.
I'm going to give everyone the answer because everyone wants to know this.
Welcome to the Financial Leadership Podcast. I'm David Aframi, CEO and co-founder of BAM Advisory Group. Each week on the show, we're going to talk about how to build lasting wealth, take control of your financial destiny, and lead with confidence in every aspect of your life. We'll also dive deep into what it truly means to be a financial leader for yourself, your family, and your community. Let's go. On today's episode, we have Jonathan Solsbery, founder and owner of Solsbery CPA. He is a licensed CPA and worked in public audit and advisory practice for over 10 years. His experience includes advising Fortune 500 companies, consulting on IPOs and acquisitions, and restructuring, and implementing and auditing internal control environments. He spent 4 years in Bermuda focusing on private equity and insurance startups. Jonathan also has 13 years of experience in retail management with a focus on process development and loss prevention. Cool. Hey, Jonathan, you've been doing taxes for a while now. What's the single most common mistake you see retirees make on their taxes that cost them the most amount of money?
Honestly, the most common is it's not planning for a significant event, right? The day-to-day, the kind of routine investment income, you're getting Social Security income, whatever you're getting on there. It's the larger events that happen and it's not having a good strategy around it. So whether it's you had to make a very large withdrawal, you got a very large, let's say, inheritance or windfall of cash, or you sold a very large asset, and it's not having good planning around the timing of it, the structure of it, and how you're going to treat that income when it comes in, right? And so what happens to me very commonly in those scenarios is they're coming to me the year after, right? And they're saying, this is what happened. And I say, that's great. That's what happened. And I'm going to report what happened. There's nothing I can do, right? So let's say, give you a real world example of selling a business, right? That's a big one, right? They own a business or they're an investor in a business and they sold the business and you have a very large windfall of cash, right? That happened in the past year. The sale's already done and the ink is dried and they've already paid you for it. And then they come to me and say, hey, I'm going to get this $2 million windfall of cash from last year. Tell me what I can do to reduce my taxes on it. And I go, well, that happened last year. There's nothing I can do now, right? You got the cash in the bank. You signed the paper. It's done, right? And those types of events, that's where in that process, along with that process, is consulting with someone from a tax perspective, right? And having someone involved very early on in that process that says, hey, I'm planning to sell my business. What would the tax implications be? And how can I plan for that, right? How can I plan and reduce my liability on that, right? And that's where having someone early on in that process would have made a very big difference for them, right?
I think there's this misconception out there where for clients, they feel that, and I'm not knocking CPA, a good CPA is very important. They are. And I think a good financial planner is important. I think the problem is that CPAs and financial planners, for some reason, don't communicate very well. We tell our clients, hey, we're the quarterback of your financial plan. We do tax planning, but this is where I think clients get confused. What we do at BAM Advisory Group, we do tax mitigation planning. That's looking forward. That's like planning for the sale of the business, planning for large withdrawals, being ahead of the game. But we need a CPA to make sure that, hey, this is our plan for these clients this year, next year, the next 5 or 10 years. Give us some perspective on your end, because again, your role is to make sure they pay the least amount of taxes in a given year. And this is where I kind of see where some clients get it wrong, is they don't have that relationship where their financial planner and their CPA are talking a lot and making sure both are working together. Can you tell me what is your perspective on the relationship that a client should have where the financial planner and the CPA are working together? Where do you see that done right, and where do you see that done wrong?
Right. Yeah. No, it's a really good point. And I think it goes a little bit to specialization, right? There's the beauty that we have of people who have had the ability to specialize in something, right? I will never be able to give someone advice at the level that you have, just from your experience and your level of time that you've spent in your industry and what you do, right? Now, there's crossover between what both you and I know, but there's nothing that's going to replace the combined knowledge that we have in putting it together, right? You understand a lot about taxes and you understand a lot about some of the main strategies in taxes. I understand a good amount of investment and investment planning, but you and I on our own are not going to have the same, right? We're not going to get the same benefit as that combined knowledge and putting it together, right? So you have to have that specialty. You have to combine those two skills. And where it works the best is there's communication between those two parties, right? And the taxpayer has to be the one who at least initiates and brings those together, right? They don't have to be involved in every conversation. They don't have to, uh, they don't have to make sure that those conversations happen, but they have to set up that environment where, hey, this is my investment advisor. Hi, this is my tax preparer. I'd like you to meet each other, right? And then those two individuals need to be the type of parties who want to communicate, who are willing to take the time and talk to each other, right? And make sure that they really you need to have that freedom where hey, we're doing something here and it's going to be very easy for me to say, hey, can we get on a meeting and chat about this real quickly, right? And I'm going to be willing to take the time and meet with you and give you my thoughts on it, right? And make sure that we're working towards the same goal, right? I'm going to denigrate my industry a little bit. Historically, a lot of people who are tax CPAs and tax preparers and what they do for a living, a lot of their focus is around the forms are filled out correctly. Everything has been reported in the right box. We've checked all the boxes. We've made everything, all the proper disclosures, and we've signed it and it's been timely filed, right? And that's great. That's a good service to have, right? But that's not adding value for your client, right? That's not saying, hey, did you know we could do this, or this is available to you, or that could happen, right? So you need to have, first of all, someone who wants that more consultative type tax practice, who wants to do above and beyond just the tax preparation itself, right? If you want someone who's just going to fill out the forms correctly, that's your H&R Block, that's your Jackson Hewitt, that's do it yourself on a lot of these tax, software that are out there, right? You want someone who's going to give you that extra level and be consultative. That's where, obviously you're going to get more of that value, right? And my consultation needs to be combined with your expertise and your investment advisor as well, too, right? I can't work in a silo and you shouldn't work in a silo either, right?
Yeah.
And especially we'll talk about larger events, larger tax planning events, changes in your portfolio. Obviously, there's things that are changing in the industry and in the world and all these things as well, too, right? Those types of things, that's where that relationship really comes in handy. And that's where you're going to be able to get the value of both those combined expertise, right?
Yeah, no,
does that make sense?
Yeah, no, I love that answer because I love that you used the word consultative approach. You're just looking for someone to fill out the form. I mean, come on, you can do it, or H&R Block, and I kind of explain our value add for our clients when they come to us, because I say, hey, if you're just looking for investment advice, you can get that. First of all, you could do that yourself, or you can get that at the big box firms or whatever it is. But if you want real planning, real, life event, this is what's going to happen. How's it going to affect taxes? How's it going to affect legacy? Is it going to increase your Medicare premiums? There's so much more to taxes than just filing the form, just like there's so much more to financial planning and retirement planning than just what the S&P did this past year. So I love that answer. Right. I want to dive into the most recent tax legislation, the One Big Beautiful Bill, because I think there's not enough education out there. I think a lot of clients are confused. If you had to explain what the Big Beautiful Bill, the changes in plain English, what do you think for the average client maybe that you work with, maybe has a $500,000 to $3 or $4 or $5 million in net worth, someone that's approaching retirement, for those types of clients that you're working with, what are the real changes that you think are positive for them?
Honestly, for a lot of people, if you're at a higher net worth, right, a lot of these changes are phased out for you, and that's part of what a lot of people are missing in this, right? Obviously, if you're not employed somewhere, there's these tax on tips changes. There's this tax on overtime changes. There's a lot of changes at the lower levels. I'll use AGI, right? But let's just call it at a lower level of taxable income, right? You get into some of these other things that are now available to people that weren't before. But it's really at, when we're talking around a lower level of income. Once you usually get around, and I'll talk about the ones that are probably most impactful there, right? But for a lot of people, single, once you start to get above 200,000, you're going to be phased out on most. Married, once you start to get above 400,000, you're going to be phased out on a lot of them. Let's say, for example, right? The main one that for most people, I believe, and what we kick the tires for every single one for everyone, right? If it's available, we're going to make sure we're looking at it, right? The big one that most people will most likely be impacted on is the itemized deduction. And this is, I'll use the term SALT, but it's the state and local taxes, right? This is most likely going to be impactful for most people. And generally what that is for itemized taxpayers, and I like to say things in really pure English, right? This is the other way I try to set myself aside, is not use too many tax terms on there, right? So I won't go over it in detail on it, but basically there's two, we'll call them the deductions, right? There's two main deductions that the IRS gives everyone, right? You can itemize or you can just take the standard number. And in basic terms, what the IRS says is we don't want to comb through a bunch of detail for everyone and make everyone do an itemized deduction and figure it out. So you know what? Here's the number, and let's call it $30,000 for a married person. If it's going to be anywhere below this number, we're just going to give you the $30,000. We don't need stacks of receipts. We don't want to go through it. We don't want to check it, right? Everyone gets this amount no matter what. If you're way below, it doesn't matter. You get this. It's only if you're above it, then we're going to get the detail, and we want all the detail, right? So for a lot of taxpayers, for many, many years, they've never even thought about an itemized deduction. They've always taken the standard. They've never been anywhere close. Let's say they're married, they take the $30,000 every year, and that's it, right? And they've never even thought of doing more than that. When we look at this change where the state and local taxes, that has always been capped at $10,000. Now, for a lot of people, it's increased to $40,000. So what that means is a lot of people who have never itemized, never thought they would be itemizing, never got close to itemizing, likely will get a benefit from itemizing where they've never done that before. And then obviously a lot of people who have been itemizing, that itemized deduction can increase quite a bit more as well too, right? So, and if we think of it in real basic terms for a lot of people, let's say you're a married couple and you both have a W-2 and you're both paying state taxes out of your W-2. All those state taxes on your W-2, we're going to put in there as part of that itemized deduction. Then we're going to take your home mortgage, your primary home mortgage interest, and we're going to add that on top of it, right? And right there, you're going to be, generally speaking, you're going to be above that 30,000 amount, we'll call it, right? And then obviously, once you're above, you want every other dollar on top of that as well, too, right? So we talk about where you've got mortgage insurance, where you've got insurance on your home, where you've got property taxes, or where you might have had some other kind of state taxes, use taxes, you bought a very large vehicle, large piece of equipment, charitable donations, right? We want to maximize every single dollar after that, right? So that's probably, from the one big beautiful bill, the one that most widely people would experience is going to be that one.
Okay, that's great. That's a great That's a great takeaway. That's a huge difference. Standard deduction or itemized deductions were $10,000. Now that you can be as much as $40,000. So for certain people, that's gonna move the needle. It sounds like
it can be a very large change for a lot of people, right? And it's the same if you think for a single individual, right? Normally, I'm using rough numbers on everything here, right? Let's say normally you took the 15,000 standard deduction, you were always somewhere around there, right? If you have a pretty reasonable salary, you've probably got about $10,000 to $12,000 of state taxes taken out of that, right? Or if it's income taxes, you're self-employed, same thing, right? All your state income taxes there. We take your property taxes, we take your home mortgage interest, you can be getting double or triple what the deduction is that you normally would have got there, right? So for a lot of people, it can be a very significant impact for them.
No, that's good. And to me, again, I'm a financial planner. I understand the standard and itemized deductions. Clients are bringing in their tax returns when they meet with us. From my understanding with the one big beautiful bill, and maybe you can help our audience understand this. I've read things that say, hey, this tax changes are permanent. Then I've also read that, it's only good through 2028. I mean, what's the real answer? Because I always feel that tax laws are always in pencil and not in pen.
And so, if we think of the last one was the Tax Cuts and Job Act, right? TCJA. Before that, I'm going to forget the name on it, right? So we've always got these acts that come through. And then every time we have a new one that comes through, it does two things. it ends some, it makes some permanent, and then obviously it adds some new ones as well too, right? Most of them have an expiration date, and then when that date comes, they may make it permanent, they may reinstate it, they may end it as well too, right? The common one that a lot of people probably know is the QBI, qualified business income deduction, right? There was a question right here with this last act. What would happen? Would they extend it? Would they end it? Right? We didn't quite know, right? And they kind of made that thing permanent going forward now too, right? The one I was just talking about there with the interest, and you don't get me wrong on these. I didn't give you my big caveat that I give at the beginning of all these speeches, right? So if I get a date wrong or I get an amount wrong here, right, you guys will, I'll give you the big disclaimer and then you could plug it in at the beginning of the discussion here, right? I want to say that one going to end right around 2030, somewhere around there is where it currently is set up.
It just changes so much. You know, it's really important that you're working with the right professional. Now, you mentioned a lot of these changes are you know, high income earners are phased out. What planning opportunities, if any, does this create for high income earners? Is there anything within the big, beautiful bill that a high income earner can say, oh, I didn't have that before. That's for me. Or they're not going to be able to take advantage of anything new.
You know, they might get a couple advantages on some of these ones. And again, when we look at, you know, really how much was your actual taxable income, right? There are a lot of very high net worth individuals who don't actually have very much taxable income every single year, right? Or they may have some years with very low and some years with very high, right? So, you know, that can be an important distinction there as well. There's obviously, they get the catch up contributions for senior individuals. The senior standard deduction has gone up as well too, right? There's some interesting rules there around, I'll call it 401k and retirement planning. And it's called the Secure, if you've seen the Secure 2.0 Act as well too. That did some interesting things there as well, as far as like what the caps are. And when you go between a Roth and when you go between a regular IRA. And I won't try to get into the details on that one without having my notes in front of me, because that one's, you know, pretty complex. But there's a couple things there, right, that can be really impactful. The other one that, you know, a lot of people probably didn't think about, but it actually really did change. There's the limit on this estate, right? When you have an estate transfer, right? Or when you get an estate, as far as being a beneficiary of estate, that's moved year over year over year, right? There's a lot of people who have this concept in their mind around trusts. I need to put everything in a trust. I need to have a trust. Everything needs to go to trust. A trust gonna, you know, save money on that. That used to be the case quite a while ago, you know, right around, let's say the early 2010s in that area, right? That number now, it's moved from about 500,000 to $1 million. It was 11.5 million. I want to say with the Tax Cut Job Act. And then now with the one big, beautiful bill, that's moved up to it's 15 million or 15.5 million, right? And what that means is, in essence, when you're the beneficiary of a decedent, right? When you're getting their estate, anything below that number, you're not going to run into tax on it, right?
Okay. And that's per individual. So a husband and wife have almost, you know, 30 million, maybe a little bit over 30 million that they could pass. Excuse me, that they could pass to their kids,
or think of it per kid,
before
right?
the estate,
So
before the estate
then,
tax kicks in. Is that correct?
Right. So if they have 2 kids, right, then the 2 kids get 15 each, and they're good, right? So per whoever that beneficiary might be, right?
And that estate tax is what, 40%?
It can be, yeah. Well, and that gets pretty interesting too. That's another one to talk about when you talk about what are they actually getting in that estate, right? And a lot of people get into, you talk about basis, right? You get the step up in basis, right? That's a very common concept that everyone talks about, right?
Yes.
Where it says, you know, hey, you know, my father invested in this stock right here, right? And this stock, he bought it at 20,000 and it increased in value to 100,000, right? I got it upon, you know, that then came to me as far as his estate, right? And my basis, right, my beginning value in that is 100,000, right? So if I ever sell it, I'm only going to pay gain above on that 100,000, right?
So is the stock? So in my understanding, again, I could be wrong. This is why we work with CPAs. My understanding, your life insurance, your IRAs, your investment accounts, real estate, stocks are part of the estate. Is that incorrect?
That's correct. So stocks, assets, right? Assets, yes. IRAs, especially, like let's say they had a 401k or a Roth, right? That stuff, they've already got tax advantages on it. They've already received tax benefits for that in the past, right? You do not get that step up in basis there.
Correct. Right.
Those
but all of those accounts, but all of those accounts are part of your estate. Yes
that's
or
correct.
No?
Yeah. That's correct.
That's the question. Yeah. Yeah.
Obviously, as far as they're set up correctly, right? They're part of that, right? It's the step up in basis thing that people get wrong on there, where they say everything that I'm going to get as a beneficiary, I'm going to get that step up in basis. It doesn't qualify for a lot of certain types of assets, right?
Right. It's for those assets, it's taxable accounts, brokerage accounts. But yes, IRAs have different rules. See, ladies and gentlemen, if you're listening to this, it's so important that, first of all, you need to understand what it is that you own and what it is that you may pass. How it's taxed. That's all taxed differently. Like Jonathan said, some of it you get a step up in cost basis. Some of it you're going to have to pull out over a certain amount of years. We're going to talk about the new Secure Act 2.0 here in a minute. But then, having trust, having will, talking to your financial advisor, coordinating it with your CPA. I mean, those conversations are so important because what we see a lot, and it's not with our clients, because with our clients, we're educating them on a daily basis. We get to know their CPA, we get to know their estate planning attorney, and we tell our clients, again, we're the quarterback, but we want to make sure that we're having those conversations now so that your estate transfer is the most tax efficient. And what we see people do wrong is that, we'll have a client call and go, oh, my parents just died. We weren't working with their parents. We work with the kids or whatever. And oh my gosh, I can't believe what, first of all, they're dealing with a financial, or they're dealing with an emotional loss. I can't believe that my parents, they left us money, which sounds great, but then it's, oh my God, it's taxed all differently. What a mess. I wish we would have had a plan. Do you ever hear clients, talking about that, or someone saying, hey, I just inherited wealth from my parents and seen it done wrong, and it cost, the beneficiaries tens, if not hundreds of thousands of dollars in taxes?
Yeah, it can be very common, right? And this is where we get further into this conversation, right? So you've got a relationship between your tax preparer, you've got a relationship between your investment advisor. You need some legal advice in there as well, too, right? When we're talking about trusts and estate planning and all that type of stuff, right? There's a legal element to these things, right? Where if you don't have a reasonable level of legal counsel, again, I have a reasonable level of experience and knowledge with that, but I'm not going to be a replacement for someone who does this for a living and does this, that has that specialty because they've specialized in this for so long, right? Now, obviously, I'm sure, especially if you're someone listening right now, you say, okay, so I got to spend money on this and this and this, right? And, I won't defame that profession, but they like to charge a lot for a very short amount of time, right? And a very short amount of work. Just from the beginning, I see so many trusts from clients that they send me. They have not set it up correctly. The trust agreement itself does not properly define what type of trust it is, what type of category it sits in. And they have not gone through the process of actually legally transferring assets into the trust. If they actually look at where the legal assets are held under, they have not, you have to go to the county clerk or wherever you got to go, and you've got to get these things moved over into that trust, right? It's not just the fact of signing over the document, right? Those assets, especially when it's a home or, whatever it is, you have to make sure those have been put into that trust and moved, right? And that's a big step a lot of people miss. It's just doing that from the beginning. And then there's the irrevocable versus revocable piece, right? Which for most people, it's the revocable is what they have, right? Whether they realize it or not. And so it's very common for me. Hey, I also have this trust. I need to file a tax return for this trust. No, you don't. It's a revocable trust. They're still your assets. You can pull them out at any time. It's, it's good to have. It's a nice thing to have. It's just a legal document, right? There's no actual tax implications from something like that, right?
I look at it as if you've spent 30 or 40 years accumulating a ton of wealth, I think it's a small cost to have a good estate planning attorney making sure that all your documents are in order, and when you pass away, the directions that you gave to your trust are honored, and then we try to avoid probate. A good CPA annually should be making sure that the work that the estate planning attorney and the financial advisor are doing, makes sense. And then a good financial advisor, should be more about should just not be about investment management. It should be about all, the tax planning, the healthcare, long-term care planning, the estate planning. And that's what I want to jump into next is estate planning, because this is where I see the biggest mistakes. And, we can jump right into the Secure Act 2.0, because at BAM Advisory Group, we work with clients that have, our general client has, $2 to $3, $4 million of net worth, some even a lot more. And, I think they don't understand the impact of, let's just say, and most of the clients that we talk to, and I think most people, and you look at people's tax returns, so maybe you can, give me some perspective. We see that most people have wealth in 401ks and IRAs. That's where I think most people have saved their money. Now, if you understand the tax code when it comes around those accounts, the IRS is, every 3, 4, 5 years is always changing the tax code. Where they have the most, where they move the goalposts a lot is on IRAs and 401ks. And if you're sitting here listening to this and you're like, yeah, I'm going to leave my kids a couple $1,000,000, but I've got 90% of my money in IRAs and 401ks. When the Secure Act 2.0 came around, they changed the stretch RMD provision. Talk to me about some of the rules that you saw with the Secure Act 2.0, and then how, where is it not tax advantageous for beneficiaries to receive IRAs?
Yeah. And, this is one on there where it's just so complex, and it's one on there where when I get into this topic, like, let's say, and when a client asks me a really pointed, and of course we don't talk about Secure Act, but pointed questions around these things, it's very common. I'm not going to give you a direct answer, or at least immediate answer, right? I'm going to take it all down. I'm going to pull it away, and I'm going to come back to you. I'm going to give you the answer on it, right? And this goes, this is just overall tax advice that I tell people as well too, of like, the way it's written and the way the tax code is, it's here's the rule, except for this, and in this occasion, unless you fit over here, and subject to this and with this, right? This is one of the things we get a lot on all the search results that you get now, right? It gives you that little AI summary, right? It gives you that little like AI search result, right? For taxes, that thing is far, far off, do not, you can use that as a general idea, but follow it through. You have to follow these things back through the code, because it does get really complex around some of these things. Just generally speaking, obviously those required minimum distributions they're gonna create a problem for a lot of people at a certain time, right? Where now is not a good time for me. I don't need to be taking that income. I don't want to be taxed on that income right now. And it's going to happen, right? And it's going to hit me, right? So that can be a problem there too. And one of the, maybe one of the more popular, I won't call it a dispute, but where when I'm meeting with investment advisors and where we're trying to figure out the right answer on something, it goes a lot into traditional versus Roth and what's the best answer between the two, right? This is probably a very common dispute between a lot of people of, should I do traditional or should I do a Roth? Which way should I set it up, right? And obviously in a perfect world, you can do both, right? And that's, you take advantage of everything, right? When you have to choose, this gets into a little bit what you're talking about of like, what's the applicable tax right now? What's it going to be later on down the road, right? And do we know, right? We don't know, because it's always changing, right? What's the general concept that anyone will tell you when they're talking about this type of stuff is basically, hey, are the taxes going to go up or the taxes going to go down? You're going to pay more taxes in the future, right? Or that's what a lot of people will tell you around that. So that will push you towards Roth, right? Do the Roth, pay the taxes now. You won't be paying tax in the future, right? First of all, we don't know that that's always true, right? That's not especially always going to be the case. And then secondly on there, very likely when you're in your higher earning years is when you're working and when you're younger, right? Doesn't mean that you won't have a lot of net wealth when you're in your retirement years, right? But the actual amount of, we'll call it taxable income that you're going to have during that time will likely be able to be a lot lower, or you can manage it so it's a lot lower, right? When you're in your working years and you're a salaried employee somewhere, or even if you own your business, there's only so much you can do to manage how much your taxable income is going to be, right? If you're making a very high 6-figure salary, it is what it is, right? You're not really going to want to lower that, right? When you're in retirement, you have obviously a lot of options around where you pull your money from, how you take care of yourself, right? And in a lot of scenarios, you may own your home already, right? You may own a lot of the things already, so you don't have a lot of, out-of-pocket living costs, right? And then what do you actually need for your day-to-day living expenses, right? And you can manage where that comes out of your different portfolios, right? Maybe you have a lot of munis, right? Maybe you're getting tax exempt interest out of those and you're taking a lot of that, right? You're also looking at, if a lot of people don't realize this, and again, the laws can change all the time, capital gains on there, right? When you get long-term capital gains, when your taxable income is very low or zero, there is a 0% tax bracket on long-term capital gains, right? And a lot of people don't realize that, where I have clients who they have a certain, I'll call it kind of a one-off year or an exceptional year, exception year, right? Say, hey, this year, I'm going to be making a loss this year, right? Or, hey, I'm kind of taking a year off. I'm not going to work very much this year, right? My taxable income for the year is going to be extremely low, right? This is somewhere where I would work with an investment advisor in that year, especially, and say, hey, we've got an exceptional event, right? This person's a high net worth earner and they've been that way every year. And for this one year, because of these events, their taxable income is going to be incredibly low, right? So what can we do in that year, right? And, I'll give you an example. You might have something that has a very large long-term gain on it and is likely not going to stay, right? For any number of reasons, or you want to capitalize on that gain right now, right? Sell that investment, crystallize that gain right now, up to the amount that you're going to hit the 0% capital gains tax on it, right? You're not going to get a chance to do that at another point in time, right?
Yeah, no, for sure. I mean, that's a good point. So again, what our practice is built around doing the things that we see a lot of advisors don't talk to their clients about. And that's around taxes, tax loss harvesting, tax mitigation. Hey, you've got all this money in IRAs and it looks like you're going to be at a lower tax bracket when you retire. But when these IRAs continue to grow, now your RMD's at 75, you're actually going to be in a higher tax bracket down the road. And that's if taxes don't even change. So we show our clients that, but I love that you brought up the zero tax, where it's based upon your current income in a given year. Like you just gave a good example. Let's just say, hey, this one year I'm just not going to have income. I didn't want to work. I've got all these other, whatever it is. And you've got, a bunch of money in a couple stocks. It's probably a good time to harvest those gains. And in certain situations, you can do that and not pay any tax or pay low tax. We pay attention to that all the time because, we'll have a client that, I think one of the things that most people understand is that if you touch a retirement account before 59 and a half, there's what we call early withdrawal penalty. And we meet with clients who've got a lot of wealth in after tax accounts that, the tax brackets are different in non-retirement accounts than they are retirement accounts. And, you get someone that's 55 that doesn't want to work, but they've got, a couple $1 million in a after tax account, but they're like, well, I don't want to touch this money because of the capital gains. Based upon their income, if you're married, that 0% tax bracket is pretty high, if you're married and filed jointly. So I love that you brought that up. So getting back to the Secure Act 2.0, it's my understanding that, before the Secure Act 2.0 was passed and you inherited an IRA, you could stretch those distributions over your lifetime. My understanding of the new Secure Act 2.0, if you inherit an IRA today, you have a 10-year window. Is that 100% accurate, or can you give me a few examples where that is the case and then where it's not the case?
I'm going to tell you that's generally speaking what I've read. Yes.
10 years.
That 10-year window.
So inheriting an IRA could be expensive. So if you're in your 60s and you're like still working and you're in your high income years, or you just retired and you've got Social Security, you've got a pension, you've got capital gains. Next thing you know, your parents unfortunately pass away, but they leave you a couple $1 million inside a traditional IRA or 401k. That could just blow up your tax bracket for a period
Right.
of time. Is that correct?
It's a compounding effect on all of these things, right? So yes, you've got to take that minimum distribution and pay the taxes on it. Yes, right. And then what is that doing overall? That's increasing your total taxable income as well, right? So what's that likely doing? That's moving capital gains from 0 to 15 to 20, right?
Yep.
That could be pushing you into, we'll get into if we need alternative minimum tax, right? A lot of people that can push them into those types of things. And the other thing that it's done is some of these, potential deductions for people, it's phasing you out on all that stuff as well too, right? So it's not just one impact from that, right? It kind of has multiple impacts that carry through on other things as well, right?
And if you're sitting there listening to this and you know that you're going to leave wealth behind because you've accumulated a lot, you're not going to spend it, or you want to leave wealth behind. Isn't this where, and I'm not saying this is a blanket statement, it's not a one size fit all. You really got to have a customized approach. You got to coordinate the conversations between your attorney and your financial planner and your CPA. But isn't it where if you're sitting down with the client, they're like, yeah, what are your goals and objectives? Because I know you're consultative, you approach each client differently. You're very consultative. It's not cookie cutter with working with you. But if you sit down with the client, they go, hey, what are some of your goals and objectives? Like, I'm going to leave wealth behind, but I want to do it. I've never met a client who says, hey, I want to leave money behind, but I don't want to do it tax efficiently. But if they've got a bunch of money in IRA and they'd be okay with paying a little bit more tax today, isn't that where potentially converting to a Roth could be advantageous? Because if you pass away and you leave that wealth as a Roth and then your beneficiaries, that 10-year window still applies, isn't that where generational wealth can be creative if they do tax planning ahead of time?
Absolutely. And when we talk about Roth too, for high net worth individuals, most of them are phased out on these as well too, right?
Right.
So what's the really common one? And you guys are probably seeing it all. It's the rollover, right?
Roth conversion.
Roth conversion and the rollover, right? So you do the non-deductible to the traditional, then you roll it the next year, and then you keep doing it year after year after year. And then there's conversion as well too, right? Where you're just taking it and you're converting it. And again, this is where that relationship, and I had a lot of meetings right at the end of last year on this, where he said, hey, they want to do this. Let's look at it. They send me their calculations. I run through all the other, income figures I have for the client. And then literally I can tell them, right? And we came down to a very simple calculation of said, okay, you want to convert this much, right? We're going to do this much as a Roth conversion this year, and you're going to pay this much tax on it, right? And we calculated them, I'll call it 12%, right? We basically said, overall, all other factors considered, you're going to pay a 12% tax rate on this by doing this year, right? If you look at any other future year, this is probably going to be the best tax rate you're going to get on this, right?
Yes,
so that's
for
very
sure.
easy for us to make that decision for them and say, hey, this is the right thing to do. It makes absolute sense. Even though, you're going to have some out-of-pocket tax this year on it, right? Getting it at this level of a tax rate is perfect and it's great, right?
Yeah.
And that discussion with their investment advisor was very timely because they are getting very large payments from the sale of a business. And we did it in a year where they did not. Had it hit in another year, the impact on capital gains, it moves it from a 15 to a 20%. Has a very big change there, right? So that's a perfect real world example of where that relationship makes so much sense, right?
Yes, I love that. Proactive tax planning. Like, we do most of our tax planning for our clients at the end of the year because we want our clients to spend their money, enjoy it, live their life to the fullest. But that's a great example. You've got a client who's living off of reasonable income, and if it's mixed up between Social Security, some IRA, some pension, they could be in a 12% bracket. I think most people don't maximize that bracket because for certain people, if they still are 5 or 10 years away from their RMD and they've got, $1 million or $2 million in IRAs, at some point it's not going to be at the 12%. They're going to be forced into a higher tax bracket. And I think that those conversations with the right financial advisor, that's what we do at BAM Advisory Group. And then having that CPA vet our recommendations, I think is the perfect example of what a good relationship looks like for a client when they have a good CPA and a good financial advisor.
You might enjoy this one too. This is a very initial conversation with so many clients, and it's probably more the younger ones, right? Where they say, what do they want from me, right? And it's always, I want to pay as little tax as possible or no tax, right? And what happens is they read in the news and they tell me like, I hear all these really wealthy, I hear Elon Musk didn't pay any tax in a year, right? I hear that Amazon hasn't paid taxes in a year. So I want you to set me up so I never pay taxes at all, right? And we work backward from that, right? Where we say, look, yeah, there is a structure I can put you in that, you could personally achieve that, but you don't want that lifestyle. You don't want to be living that way. You don't want the headache of managing that, right? And that's just not the type of person you want to be, right? There's lifestyle decisions you have to make for some of these things in order to get there, right? And then I think there's also a very good concept around complexity where from a taxpayer's perspective, you don't have to understand everything, but you have to understand at a general level what's going on, right? You yourself individually, you can trust your advisors, you can trust other people to manage the very complex parts of it, right? But and this is kind of one of the other topics I commonly cover, is there's a very certain level of understanding that you yourself as a taxpayer have to have, and you have to know, right? You have to have a certain level of responsibility for your taxes and understand what's going on. And so there can be a downside to some of these very complex decisions and structures that people make, where someone passes away, someone's gone, something changes, and you're stuck with trying to manage something that someone set up that you don't understand, and it's not being properly managed, right? And you're losing the benefit of it, or it's too much complexity for what the benefit was, right?
No, that's
so
great.
There's a lot to that of, finding that right balance of, this will make you comfortable that you're in the best possible tax situation. You're achieving your lowest possible tax liability right now. And here are some other options, but only if it makes sense for the added complexity, the added, amount of time that you're going to need to, make sure this is managed properly. And then, obviously, if something happens, trying to unwind some of these things or trying to manage some of these things can be very difficult.
Yeah, no, hey man, there's no free lunch. Taxes are pay me now or pay me later. And there's pros and cons to all of it. I want to spend, we've got about another 10, 15 minutes, and I really appreciate your time. This is great. I want to talk about charitable giving, because what I've noticed since COVID, our higher net worth clients are becoming more charitably inclined. When it comes to taxes for some higher net worth families who do give to charity, what do most people misunderstand right out of the gate, do you think?
Honestly, charitable is pretty, I want to say it's easy, it's kind of hard to screw up unless, of course, whatever, what am I trying to look at? Whatever kind of, people you're giving to, whatever kind of charitable organizations or whatever type of causes you're giving your money to, and you don't have to completely vet them, right? But you have to make sure that they met that status, right? And you have to get whatever you need from them so that you have that documentation that it is a vetted charity, right? That it's an actual charity, right? Probably the other big one that I work with a lot of people is setting it up through a trust, right? This is one type of activity where a trust can make a lot of sense, as these charitable remainder trusts, these CRTs, right?
Okay.
Where you have the ability and you kind of have the obligation where a certain amount of the trust has to go to charity, has to be paid out through charity, right? But then you have a lot of that flexibility with it as well too, right? Where you can you could have a certain amount that also goes to the beneficiaries, but doesn't have to every single year, right? And so those types of structures, first of all, can be really beneficial to have. And for someone who is very philanthropic and likes to give a lot to charity, that's usually one of the better structures to set up for them, right? And it's obviously where they also have the long-term plan that a certain part of their estate is going to go to these certain charitable organizations there as well too, right? Mm-hmm. We harped on it a little bit too, the SALTs and the increase in the itemized deduction for certain people. Charity is going to become a huge one there as well too, right? That's one of the easier itemized deductions to increase, right? There is a new cap on there with HEI, and so there's a little bit more of a cap on some of it. But people who are very large charitable givers who like to be very charitable, it's kind of it's an easy benefit to get, right? It's an easy gimme, right? As long as you just have the right documentation around it and who you're giving it to, right? And then you avoid there's a lot of bad advice out there around, this celebrity, they set up this charity for their family and then they're donating to this charity and then it's their family and it's a taxable, it pays their taxes on their behalf, right? There's a lot of odd strategies in there, right? But truly pure, actual philanthropic work, people are generally just trying to give something good to a charity. That stuff's pretty straightforward. And obviously, especially in its into cash form, right? When you're giving assets or when you're giving other things like that, that can add some complexity there. And there's a little more work to do.
So let's talk about, we're getting back to gifting. I've had clients want to gift more just because they like the fact that they can see some of their wealth affect positively their kids and grandkids today versus how they inherited money, which was their parents never talked to them about it and they just passed away and dumped a lump sum and that had some tax problems. Where do you, in your practice, do you see gifting is working well for your clients?
Yeah. Well, and the first one is a very common misconception around who gets the tax benefit there, right?
Okay, good.
So it's after tax, right? So when you're I'm going to call it the gifter, right? Not the recipient, the one actually giving the gift. This is after tax money, right? So you're not getting a deduction on this gift, right? Where the benefit is for who you're giving the gift to, right? That doesn't become taxable income to them, right? And you probably know the amount offhand that changes every year. I think we're somewhere around 17, 18,000.
Right around there. Yeah. So what you're saying is that the person that receives the money is getting the benefit. The person that's gifting the money, they've already paid tax on it.
Right. It's money you pay taxes on, right? But obviously what's happening on there is obviously the person who's receiving that money, right? They don't have to include that as income on their end. And you want that money to they want them to use that money for a very wise purpose, right? Obviously, there can be a lot of different ways you can set that up, right? But if you can gift that much and you do it every single year, right? So you want to make sure you're maximizing it every single year to whoever you're giving those gifts to, you're moving that to them already now. And in a smart world where they follow what you tell them to do, they're going to invest that now, right? And they're going to set that money aside, right? They're not going to use it for, whatever they might, want to do at a younger age, right? You want to understand that if you can take that much money now and you can put it aside, whether it's in a retirement account or whether it's into, any type of investment vehicle, if they understand the growth and where that's going to move over time, right? That's the value for that person, right? And that's really what you're doing with giving them that gift, right? And then obviously what you're also managing is you may be trying to reduce how much that estate is at the end, right? If you're close to exceeding that limit already, or what are you kind of doing? They're getting a bit of that estate now. They can go ahead and start investing it now and building their own wealth with it as well too, right? So there's there's the overall benefit for both parties from that perspective as well, right?
Yeah, no, I think that's a great point. I think that's where people miss out. If you, and like you said, the estate tax threshold changes every time there's a tax code change. Sometimes it goes up, sometimes it goes down. Currently it's right around, we don't have our figures in front of us, 15 million or whatever it is per individual. Getting that money out of your estate today. Cause you might be sitting here with like, well, I'm not going to be at 15 million, my wife and I. Well, number one, we don't know what it's going to be. Number two, you got to assume that your investments are going to grow over the next 20 or 30 years, depending upon your age. But getting some of that money out of your estate now, you're just slowly reducing that potential problem. So I think that's perfect. You're allowing your beneficiaries to receive this money now. Yeah, I love the fact that you said, let's make sure they're making wise decisions. And then you're starting to get that money out of your estate, which I think is big.
If you think about it too, if you think about that number, it's very close to what the standard deduction is, right? Slightly higher, but moving very close to the individual standard deduction. And this goes to another very common strategy that a lot of people use is where they're employing their kids, right? And they're paying them as an employee either for, the business that they own or, for doing something around the house, right? Or something like that, right? But basically making your child, and obviously at the right age where they are actually doing something, you make them an employee, you're paying them a salary, you're keeping it below that amount where they don't actually have to file a tax return, right? They're not actually getting taxed on the income there. And then in a lot of cases, what you're doing with that money, maybe some of it is, maybe some of it is allowance, but most of it, what's it doing? It's going into a retirement account for them, right? It's going into a Roth IRA. It's going into a regular. And so very early on, and obviously the benefit with that one, where it makes sense, is that is a deduction for you, right?
Yes.
So when you're employing your child, that is an actual tax deduction there, right?
Yep.
So that's another one. It's similar in concept when you just think about, and a lot of this is very true when we talk about a lot of this stuff. When you think about how the tax thresholds work, it's the same concept there, right? A lot of these numbers are very similar for a very specific reason, for that reason, right?
Yeah, no, it's great. If my two kids are watching this, they're employed by BAM Advisory Group. One of them I actually get to work over the summer. The other one is like, this is a cool gig, Dad. I go to college and I also get money at the end of the year. Well, I mean, it helps the business. My kids are very savvy investors. They've, we wanted to do this. And real quick for the audience, annual gift tax, annual exclusion now is 19,000.
19.
Yeah, 19,000 per year. That kind of goes up with inflation, like you said. And the unified estate and gift tax credit amount is 15 million per person. So we're right on there. Okay, let's go into our lightning round. We're just going to ask a bunch of questions. Try to give me like the simplest answer as possible so our viewers can get a bunch of value towards the end.
Okay.
Roth conversion in a down market. Yes or no? Is this a good idea?
Yes. Do not touch it for those 5 years. Understand the 5-year rule.
Okay.
A lot of people do not understand how that works and what the impact is there. Right.
Right.
So
plus they have to be under 59.5, but I think that
under the 59.5, understand that 5-year rule and how that impacts on that type of stuff. Right. On a down year, and obviously what is it? Is it a down year for you as well too? Right.
Correct.
So make sure it's the right year for you.
Right.
Right.
Okay.
There's right year for you and from a market perspective.
Okay. Right. Cause some of the thinking is, hey, if I do a Roth conversion, the market's down, I'm going to get that growth tax free. But like you said, you just can't consider that. You got to consider your overall income. Correct. That's kind of what I'm.
Yeah.
Okay,
yeah,
cool.
Yeah.
All right. Paying off your mortgage before retirement, smart or overrated? I think all of his answers are going to be, it depends.
It always is, right?
It always is. Yes.
It always is. These days, if you've got one of those great mortgages from a long time ago and that interest rate is in those 3% and whatever it is, right? I'm very jealous for those types of people. It's generally bad advice, right? It's generally not going to be good advice.
Okay.
To pay that thing off. There is one caveat I will just say to that.
Good. Let's hear it.
There is a peace of mind, and I think almost every investment advisor will disagree with me on this. If you own your home flat out, if worse comes to worse and you really, some reason, get in a really bad situation and things are going really south, right? There is some value to fully owning that home, and not having to worry about that piece of it, right?
Okay.
So there is a concept to that where, hey, if you had the cash on hand, just having that ability to say, hey, I don't have to make any other payments on this. Now, obviously, they'll still kill you with property tax and all the other things too. So,
Okay. HSA as a retirement account, underrated or overhyped?
Absolutely. HSA. All these other ones we talk about, most people phased out. HSA, not phased out, can do, right? HSA can do. HSA is just like a 401k when you reach that retirement age, right? The only caveat is whichever one you're putting it in, make sure it's one that actually invests that money wisely. If it's an HSA where it's just sitting in there in like a savings account and earning the very small amount, not worth it. But if it's the right HSA and they're actually investing it just like any other type of retirement plan, you can maximize those. Pretty much anyone can maximize those things out as long as they can get that high deductible plan. And pretty much no one is phased out based on income.
Okay. So are you saying that most people, after you've saved in your 401k, maybe you've got a Roth, whatever, HSA should be, doesn't matter if you're a low income earner or a high income earner, you feel that an HSA is probably underrated, underutilized?
Well, because everyone says I don't need money to cover health, expenses, right? I've got great health coverage. I don't have a lot of out-of-pocket costs. I don't need it, right? That's not the point. It's a retirement. It's maximizing every possible retirement account that you can. And it's a tax deduction, right? You don't get your best tax advantage by taking one strategy or one strategy, right? How you get your best tax advantage is taking every single thing available to you
Yes.
and maximizing every single one, right? So
Love
that's
that
one,
answer.
and you want to take it.
Love that answer. Okay, tax refund, good sign or bad sign?
Bad.
Well, why?
You paid too much. You would have made money on it sitting in your bank account, and the interest that the IRS is going to pay you on it is much lower than you would be getting in the market on it.
Okay.
And especially if you have a small business, if you could have been using that cash in your business, if you pulled cash from other places to support living expenses, very bad sign. I want that number to be 0, or I want you to owe $50. If I did it right, you owe under $100 or you owe 0. That's the perfect scenario for you.
Great answer. I love. No, these are good questions. Okay. Of course, you're a tax professional that does taxes for people, so I think I know you're answering this. Do it yourself taxes versus professional. Where's the line? Like where do you get to the point where if you're like, oh, I've got houses, I've got rentals, I've got this, I've got that. Maybe I shouldn't be doing this on my own. Where's the line between do it yourselfers and it's time to hire a professional?
If you're a W-2 employee and you own one home and that's really all you have, there's not much I can help you with. And I'll tell them that straight out, right? And I'll tell them, look, the beauty that you have is you have me as an advisor. You can pick up the phone anytime you need and I'll talk to you. And if something happens, I'll help you with it. I ain't going to do much for you. There's not much I'm going to do to help you out, right? There's just not the many things that you can do, right? And TurboTax is going to cost you, I don't know what it costs now, $55, whatever it might be. You might even be in a free file state, right? I'm going to charge you more than that. It's just not worth it for me to take you on as a client. There's not much benefit I'm going to add for you right now, right?
Okay.
Start investing, start buying properties. Obviously, you're going to start your own business. Anything else, once you start doing things outside of that, that's where my value comes into play. And for a lot of people, I have quite a few clients who are in that state and they know that they want to start building the relationship now because they know that those things are going to occur and they're going to start happening, right? So they want that longer term relationship with me. I'll kick the tires every year. I'll make sure they're in their best possible state. But every year I tell them, you're paying me a couple hundred more than it would cost you just to file it yourself. And I'm doing the same thing they are, right? But that's okay with them. They like that. And then there is an event that happens. Hey, this might be happening. Or, even simple things. I sold my home, right? Well, obviously, we got a kid. We're going to get a college savings plan together. Little things like that happen. And they want to start building that relationship now because they know they're going to need that type of support down the road.
Okay, great. I love that because we have clients that, our firm is generally built for people that have at least $1 million in net worth, but we get a lot of referrals from our clients' kids, and we're upfront with them. Like, look, our fees are, you could probably do this on your own, but they're like, no, I don't want to do this on my own. I want to work with a professional, and my parents love you. Plus, when my parents pass away, I'm going to inherit wealth. I'd rather build that relationship now. And we're always conscious of making sure that our clients understand the value that we create. So yeah, I understand that completely. And I love that you do that. Last, the IRS, scary or misunderstood? Or both?
Misunderstood. Completely misunderstood. Very misunderstood. And what to be worried about. People are always worried about the wrong thing with the IRS and where the issues might lie, So understand, and this goes back to where you have responsibility, right? Obviously, I have responsibility. Everyone else has responsibility, but you are still the final person that they're going to come to and they're going to talk to, right? Understand what are the most likely things that you could run into an issue with, and understand that most of these things you're not going to find out in 6 months or in 1 year, right? So they do something funky on their tax return. They take some really risky position on there and they don't hear anything for 6 to 12 months. And they go, oh, woof, we're good. No, it's going to happen 3 years later. It's going to happen 4 years later, right? And then what's going to happen is if you lose that challenge or you lose whatever that tax position is, it's not just, what you would have owed. It's all penalties and interest that have accrued over multiple years, right?
Okay.
So, it's, they're human beings. They're actually good people. I talk to them a lot. They know me quite well. Whenever I call in, they ask for my ID number and they can see my call record and they can see, my history with them. If they're good human beings over there, they want to do the right thing. I have 2 employees who work for me who used to work for them. So they are very good, reasonable, helpful people. but understand where the most likely risks actually lie, right? And people think of completely the wrong things of where, oh, I'm going to get an audit for that. I'm going to get an audit for that. No, you're not. You're going to get an audit because someone reported income to the IRS and you didn't report it on your tax return. You're going to get an audit because you filled out the completely wrong form in the completely wrong period for the completely wrong thing, right? You're going to get an audit because you left some really weird, erroneous note and letter with your tax return trying to explain something in detail that someone had to sit there and read and make a decision about, right? You know, it's just understand those types of things.
Misunderstood. Okay, good. Last question. At BAM Advisory Group, obviously we're known for high-level financial planning, investment advice, tax mitigation, all that stuff. But the what we're really known for is protecting what's priceless for our clients so that, you know, our work protects their time and their energy. If I were to ask Jonathan, in your practice, or what does it mean for you if I were to say, hey, Jonathan, if you were to protect what's priceless for your clients, how would you answer that question?
That's a good question. Honestly, you know, for me, I would put more weight on peace of mind than I would on, you know, I'm winning the game. I'm the smartest in the room. I'm getting the best advantage, right? I'm doing, you know, I'm ahead of everyone else, right? There seems to be a little bit of FOMO going on with a lot of people where they're saying, there's all these people I go out and I talk to and they tell me, oh, I haven't paid taxes in 10 years, or I have this and I do this, you know, or you're going to see them on TikTok. You're going to see them on YouTube, right? You're going to see all these people out there bragging about these tax strategies and how everyone else is dumb and they haven't paid taxes in multiple years, right? Don't buy into that. Don't listen to that. Peace of mind is more important in a lot of situations, right? So I want you to feel comfortable that whatever big advantages and whatever things that make sense for you, we are doing and we're taking advantage of those. I want you to feel comfortable that whatever changes happen and whatever new things occur, we're on top of that, we're aware of that, and we're making sure that, you know, where it applies to you, we're doing that. And we want you to feel comfortable that we're filing you timely, appropriately, and accurately. You can get an audit, anything can happen on there, but have that peace of mind, right? You know?
Awesome, man. I love that. Peace of mind. Peace of mind for your clients is what protecting what's priceless is. And then Jonathan, we'll put it in the show notes, your website, but if you want to give it to the audience, if they enjoyed this conversation and they're looking for either a new CPA or, you know, they wanted to talk to a professional, what's your website?
Yeah, it's www.solsberycpa.com. And Solsbery is spelled weird. So, you know, Solsbery. It's like Salisbury steak, but it's not spelled the same. It's like Salisbury Hill, but it's not spelled the same. If you, it's my name, my family calls me Johnny Solsbery, right? My mom calls me Johnny, but with my CPA hat on, I'm Jonathan, right? If you put Johnny Solsbery in and you put it in as an autocorrect, it's Jenny Slobbery is what it always wants to do in it. So I get that response on there sometimes too.
All right. Well, we'll put that in the show notes. And then, yeah, man, thank you so much for your time. I really appreciate it.
Right.
Hopefully our audience got a lot of information. And
you're going to pay some taxes. That's part of life. Death of taxes. We're all going to do that. If you make a lot of money, you are going to pay more taxes than other people. That's okay. We want you to feel comfortable that you're paying the lowest amount that's reasonably possible for you without going and getting in trouble, without committing fraud, without taking some very risky tax position that you're going to lose sleep over, right? That's what you want. That's the answer. That's where you want to be.
Once again, I'm David Aframi, co-founder and CEO of BAM Advisory Group. Thank you so much for watching another episode. We hope you find the information very valuable. If you're enjoying this content and want more content just like it, click the like and subscribe button. It also helps us get this show, our content, out in front of more people just like you so they can also get some of this financial education. And if you're wondering if you may have a tax problem, if you're not sure if you have a well-written financial plan, click on the scheduling link in the description to the show and schedule a 15-minute, no obligation, no cost phone call with one of our advisors to see how BAM Advisory Group can help you. You can also visit our website at www.bamadvisorygroup.com and also schedule a call with us as well. Thank you so much for watching. We'll see you on the next episode.